This is the L2 Capital Podcast with hedge fund manager Marcelo López. The L2 Capital Podcast focuses on potential opportunities in the market and brings to your industry leaders and an intelligent conversation about their respective areas of expertise. And now, here's your host, Marcelo López.
Hello everyone and welcome to the L2 Capital Podcast. I have the pleasure to talk today to the founder and editor of Grant's Interest Rate Observer, Jim Grant. Jim has been writing this excellent publication since 1983, and I strongly recommend it to all our listeners. Jim has also written a few books. One of them I have recently finished, The Forgotten Depression, which is a very good and thorough book about the recession of 1920-21. Jim, welcome to this program. It's a great pleasure to have you here and talk to you again.
Well, Marcelo, it is my pleasure. I'm so glad to talk to you.
Thank you. Could you please let us know what Grant's Interest Rate Observer is and what new subscribers can expect to get from it?
Well, we are a publication about finance. And as the name suggests, the focus is principally, although not exclusively, the capital markets. And, interest rates are, of course, among the most consequential prices in capitalism. They discount future cash flows and help us think about the measurement of risk and investment hurdle rates. And to my great annoyance, interest rates have come under the thumb of the world's central banks these past 10 years, and we have been, at Grant's, as observers of interest rates, we have been squidding trying to find them. That some of them, as you well know, Marcelo, are actually below zero. So this has been an eye-straining decade for us observers of interest rates, but we nonetheless persist, and we publish every 2 weeks. It runs to 12 pages, and typically there are 4 or 5 articles featuring typical issue, some macroeconomic comment, and then a couple of fairly detailed securities analyses, an analysis of a particular company or of a particular asset class, or of a commodity, for example. So it's rather eclectic, and we try to write in the Queen's English to avoid jargon and to make the reader's experience as informative and pleasurable as possible. And the idea is to think of things that are generally not being thought of or discussed. And, so we are try to be about the next thing, whether that be a good thing or a bad thing, but we hope to identify profitable things. So there you have it, Marcelo.
Fantastic. So, Jim, I'm going to jump straight into it. We have seen strong numbers coming from the U.S., jobs market, pressure on salaries, low unemployment rates. On top of that, there is the fiscal stimulus that the government is giving companies and all that. The GDP all the way to the third quarter has been very strong. So inflation started to pick up in 2018, although it's come off a little bit. But in your opinion, what's the Fed going to do in 2019? Are they going to raise rates, cut, reverse course, and start QE4? What do you think is going to happen?
Well, I think ultimately the Fed is going to reverse and to revert to radical policies and nostrums, because I think that the essential, as it were, the backstory, the essential narrative today is are the consequences of persistently low interest rates that we've seen since basically 2008. So the consequences of those rates, to my mind at least, are the story today and especially tomorrow and into the future. So I think the Fed is not as aware as it ought to be of what these policies have wrought. And what have they wrought? Well, they have wrought great distortions in the structure of our economy and in the pricing of assets. Private equity, for example, as an asset class is, I think, very vulnerable to higher interest rates. These so-called unicorns, that is, these immense private companies that now want to go public, they too are very heavily, many of them are leveraged, and they too will be vulnerable to a tightening of monetary conditions. The federal U.S. government's finances are likewise very exposed to the cost of capital. So America is to a great degree capitalized or structured for very low interest rates, which for the Fed presents a great problem. The Fed wants to normalize its bloated and distended balance sheet, but I think it is not really cognizant of how much strain that is going to produce in America. So you asked, what is the Fed going to do in 2019? I think it will do its best to raise its still little tiny interest rate, federal funds rate, but I think it will run into structural problems in so doing and finally reverse course and in the face of a recession perhaps or of a financial crisis have to do all over again what it did in 2007 and 8 and 9.
Okay. So do you think the U.S. might follow the same path as Japan?
No, I think, forgive me for uttering a cliche, but I think that Japan is in fact very different in so many ways. And I don't think that the outcome in America is going to be one of sleepwalking or chronic decades-long stagnation. I think it'll be rather more dramatic than that. But, I'm a great one for saying that the future is a closed book. And the older I get, Marcelo, the less I actually know about the future. And I've come to realize how little one can know about the future of finance. More and more bemused by those who pretend to be all-seeing. In fact, I reminded myself many years ago how much I did seem to know, thought I knew, about the future. So, no, I don't think we're Japan.
Okay. And all these easy monetary conditions haven't yielded to much inflation. Why do you think it's that? I mean, there was asset price inflation, but not inflation in the CPI.
We should not underestimate the significance of asset price inflation. I'm going to try to do justice to your question in a moment, but let me first observe the incongruity or the oddity, the alignment of interest rates and other asset prices. The stock market is down somewhat from its highs of late September, but sensibly it is very near the highs still. And interest rates are still very near their lows. I guess the 10-year Treasury, which is everyone's favorite benchmark, has come up from 1 3/8 or so in July of 2016 to 2 3/4 or something today. But still, in the scheme of things, these are very low interest rates, and they are anomalous because ordinarily people will not invest at very low interest rates when they can have very high profit margins, and they will not. And the opposite, if profit margins are very low, they will go for high interest rates. But we have had for many years, the world over actually, we had the anomalous condition of rising equity values and still ground-hugging interest rates. So interest rates have been manipulated, and the consequences of those manipulations are front and center. Now, you asked about inflation of the checkout counter or the supermarket variety, the retail price inflation rather than asset price inflation. And I think what may explain some of this are some of the following. We all know there has been a transformation in technology. We all know there's been international labor arbitrage, so-called. We know that the wonders of digital technology have tended to introduce price transparency where before there was price opacity. So Jeff Bezos himself personally is a force for disinflation in America and indeed, I think, in retail prices the world over.
I see.
Beyond that, in a monetary way, I think what is most important is the fact that a lot of the dollars that the Federal Reserve has created have been locked up, as it were, put on ice in the central bank itself. They have not been circulating. So I long ago, many years ago, I was expecting an inflationary expression from all of these radical monetary policies. So I was wrong about that. The standard kind of inflation has not come to pass. But I do believe that will be the ultimate outcome. I believe that all of this monetary drama will finally express itself in a much higher rate of inflation.
Okay. And in regard, now that we're talking about interest rates, the yield curve is flattening, and some parts of the curve, there's already an inversion. And normally an inversion of the yield curve means that a recession is on the horizon. We are not quite there yet. So do you see a recession going forward? And what will be the impact of this for emerging markets and high yield bonds?
First of all, if there were one fail-safe indicator, we would not have to come to work in the morning because we would watch that and take the appropriate action.
Sure.
And the yield curve has been a helpful indicator, but it is by no means, as the college professors would say, dispositive. It is not by itself enough to tell us certainly and definitively what the future holds. So I do observe with you that the yield curve is flattening, and I further understand that if banks are paying their depositors, say 3%, and if they're only earning 2 3/4% on an asset, then that is a formula for the contraction of credit because banks are making no money lending. So a negatively sloping yield curve beginning with the cost of funding, that is at the short end of the curve, that is certainly negative for the formation or creation of bank credit on which so much depends in an economy, especially a leveraged one. So anyway, I'm aware of the standard reading of the yield curve, and I too am looking at it and wondering, but I'm not sure that in itself means everything. But if you look at a broad array of market-derived measures of financial and economic vitality, you are struck, at least I am struck, by developing patches of weakness. It's not just the yield curve that is sending an amber signal or a yellow traffic lights kind of signal. The stock market has done so despite the recent bounce. Credit spreads in America have widened, and certain commodity prices sensitive to industrial demand have come way off the top. And China, which is this immense factor in the world's affairs, is finally emitting signs that the years of mispricing and of the most extraordinary leverage the world has ever seen, I submit, that these factors are coming into play in a not very bullish way. So all these are concerning things. Marcelo, I have to admit that I look for risk more than I do for happiness, at least in financial matters. So I am perhaps super sensitive to signs of developing risk. I'm not sure I see a recession, but then so few of us discern one before it is 6 months old. The Fed was not aware of the recession of 2007 to 9 until it was rather long in the tooth. So one is humble before these things. But I see the risks. I see especially the risks in China. I see them in this country, America. And I see them too in Europe, where, for example, the well-known problem child of the European financial system, Deutsche Bank, is selling for 20% of book value, with very worrying implications about its health and implications about the health of the European banking system.
Sure. Especially after the CEO said that there's no problem, right?
Right. There's nothing worse than hearing that from a CEO who knows full well there's a problem. So forgive me, Marcel, for not addressing the emerging markets aspect of this, and I've kind of vapored on about the yield curve and about my sense that something is amiss in the world.
No, that's excellent. And based on this, where people can find yield at the moment?
Well, yield at the moment is a speculation. Let's stick to dollars for a moment. World in which we Americans operate. And as you know, no one is more provincial than Americans. So I will stick to America for the purpose of this discussion. But, you can find, as an investor, typically that yield, I'm talking about yield in excess of the standard indices, but typically that yield comes, as the traders say, with hair on it, with some risk. It comes packaged with anxiety, because otherwise the yield would not be high, right? So I will, if you will give me a few minutes, I'm going to describe one opportunity we think we see.
Sure.
And, okay, so this is very specific, or as they say in the trade, granular. That's one new buzzword in Wall Street, granular. So I'm going to tell you about the General Electric 5% Series D, as in Delta, Series D, perpetual preferred stock. And this is a $5.7 billion class of securities. And it is issued, by Thomas A. Edison's old company, General Electric, which has fallen into great disrepute, well earned. Marcelo, may I read you a paragraph that we wrote in 2009, 10 years ago,
please,
about what a mess GE had gotten itself into. This is by way of preface and background to the story of the opportunity.
Sure.
All right, so here it is. So we wrote this in the aftermath of GE's somewhat shameful confession that it had been cooking the books and had paid a $50 million payment, a penalty payment to the Securities and Exchange Commission for this infraction against the laws of, I guess these are part of the 10 Commandments they broke. Yeah, so not just a technical condition. GE broke the 10 Commandments. Yeah, so here's what we said. We at Grand Central Rare had this to say. Someday, quote, someday, financial historians will try to make sense of it all, of the mere existence of a $100 billion General Electric commercial paper program. That I will stop here to explain to the listeners that GE funded itself in the day with short-dated 90 to 180-day revolving commercial paper, unsecured promissory notes, an act of the most stupendous corporate hubris. So we are saying here at Grants that historians will struggle to make sense of the fact that GE did this, that it didn't fund this debt, but rather it borrowed at the very short term to the tune of $100 billion. All right. Historians will likewise, and I resume quoting, puzzle over the ideal of shareholder value carried to the point of alleged institutionalized fraud. That's GE. An industrial company recreating itself as a highly and precariously leveraged financial institution with nary a peep of protest from the stockholders. The close brush with insolvency of a company still bearing the imprimatur AAA. Now let's stop again. In 2009, GE was going to go broke except for the intervention of the U.S. government when it was rated AAA. These facts tend to be forgotten. They tend to be glossed. But this is an astonishing demonstration of the corruption of this once great company. So I will now stop quoting from this background. So GE has been in trouble for many decades. And we at Grants have had nothing good to say about it since about the time that Thomas Edison was running the thing. So it's been a long time. All right, so getting back to the opportunity. It's a 5% perpetual preferred stock. And the securities changed hands about 81.5 or did the other day, and they are priced initially to a potential January 2021 call. And if they were called at par, or $1,000 a share, in 2 years, the yield would be 14.5 or so percent. Okay. So that's something. So if they're not called, then they should be called because they are a very expensive item in the GE capital structure. Now, if they are not called in 2 years, the coupon would reset every 6 months to 3-month LIBOR plus 333 basis points. This is somewhat technical, but in such a case, using approximately today's price and approximately the market's best guess of 2021 LIBOR, that's about 3 percentage points. You're looking, is the intrepid speculator, would be looking at an 8.2% yield for a long time. So these securities are priced for the distress that we at Grants do not think is actually present in this company, that we have had nothing good to say about for many, actually decades. So we haven't analyzed this in November, and I'm going to spare you and your patient listeners, Marcelo, with the very lengthy analysis. But we think that these securities are money good owing to the strength of most of GE's divisions and the asset coverage those divisions afford, and the income we think that GE will be able to generate. So GE is now on the outs of people who were not sufficiently cynical or bearish about it way back when, and we think that pessimism has been carried too far, and we are, in short, and to conclude, you'll be happy to know, we are bullish on the GE 5% Series D preferred stock. Period.
Brilliant. No, thank you for sharing this opportunity with us. That's very valuable.
If it doesn't work out, Marcelo, please don't call.
Sure.
No, we are standing by this, and we are quite bullish on it. So anyway. Yeah.
I know. Jim, lots of things have happened in the last few years, and many of the things that people were scared of actually happened. Plus, we have trade wars, new presidents, etc. And gold has not gone up by as much as some would expect. What has made gold underperform, and what has to happen to make it go up in the future?
The thing that will certainly make it go up, Marcelo, would be if I personally turned bearish on it. That would be a signal of all signals, because I was born in 1946, if memory serves, and I turned bullish on gold in 1945, which is astonishing. But I am seemingly wired as an old-fashioned, orthodox, hard money person. I see in the International Gold Standard 1880 to 1914. I see that as the pinnacle of institutional monetary affairs. I see gold as the essential legacy form of money, and I see paper money as a derivative still of gold bullion, even though that derivative is mostly unacknowledged by most people. So I am, this is by way of full disclosure, I am, some would say hopeless in this, but I say steadfast. So you ask, what would make gold go up? Well, I think that what makes gold go up is the loss of confidence in the institution of managed currencies, and specifically in the judgment and the policies of the Federal Reserve, the Federal Reserve being the world's dominant central bank. So insofar as the world believes in the efficacy of the way the Fed does business, and insofar as the world trusts the models of the Fed and the judgment of the hundreds and hundreds of doctors of economics in the Fed payroll, to the extent that institution commands the trust of the money-holding public, then gold is going nowhere. But I persist in believing that the faith that people at least implicitly lodge in the central bank is not warranted, and that sometime or other the scales will fall from the eyes of the trusting, and that gold will have a very, very big move up indeed. And Marcelo, I'm so glad you asked this question, because I'm always happy to talk about this problem child of mine, gold bullion. But I just received an email concerning some research that was done by some very good people in Minneapolis. In Minneapolis, by the way, it is really cold for your listeners in the southern hemisphere.
Sure.
But here is the idea. Steve Leuthold has a research operation in Minneapolis, and what he finds is he has developed something called the bridesmaid strategy. Now, this is a cultural reference that may or may not resonate everywhere in the world, but a bridesmaid is the lady who does not get married, but who is the best friend of the bride. It's kind of a poignant office in the marital rite, bridesmaid. You know,
Sure.
the saying goes that always a bridesmaid, never the bride. So anyway, the Steve Leuthold insight is that what you want to own is the asset class that is the year's bridesmaid, because next year it will become the bride. And on the authority of a friend of mine who has just now emailed me this research, the essence of the research, it has had a very, very good record. So gold was the runner-up, or the bridesmaid, for the best performance in the 2018, at least is how Steve measured it. That was a year in which almost nothing went up and gold went down only a little, or maybe broke even. So 2019's bride is going to be gold bullion. So that's one way of looking at it. Another way of looking at it, and I think perhaps more substantive, is that the Federal Reserve was on record as projecting at least 3 rate hikes next year. The stock market sells off, and credit spreads widen, and there is the stench of brimstone on Wall Street, and the Federal Reserve quickly backs down and says, we will consider things as the data come in next year. So I think that if the world were paying closer attention, it would already have lifted the price of gold, because the dollar, I think, is going to come under suspicion and trade down rather than up.
Interesting.
You asked this question about 15 minutes ago, Marcelo. Forgive the lengthy answer.
No, it was awesome.
If I may introduce one more thing concerning gold and the perception of monetary policy.
Please do.
Just today, in a publication called The American Banker, a friend of mine named Alex Pollock, who is a very thoughtful observer of monetary affairs, points out the following: that the Fed has disclosed in the fine print of a recent financial document that it had suffered $66 billion in unrealized losses on its portfolio of long-term mortgages and bonds. This is as of the end of September. $66 billion is, of course, a lot of money, even when you say it fast, but it is more than just a lot of money. It is, in fact, equal to 170% of the Fed's capital, meaning that on the basis of mark-to-market accounting, the Fed shows a negative net worth of $27 billion. And to put it less charitably, that would imply the Federal Reserve, the great central bank of the dollar-owning world economy, central bank of America and of the world indeed, is broke. Now, that is, of course, an undignified way of expressing this fact.
They can always print, right?
Well, they can print, but the question I have is, can they print net worth? They can print assets and liabilities.
Yeah.
And they can print in such a way as to allow them to perhaps invest and to earn income, but they can't literally print net worth.
Sure.
So anyway, I offer this up to your listeners as one vivid item of evidence of the unintended possibilities of so-called quantitative easing. This, of course, is what they call this great bond buying debauch of the past 10 years. And not just in America, naturally, but also in Europe and Japan.
Sure.
But I think that technical insolvency, if we can call it that, of the Federal Reserve, is just a marker. And when we look back on this moment in this finance, or this era in finance, we will see this as one of the signposts, as one of the indications that things are not as they seem.
Quite interesting. That's the kind of insight you expect from you, Jim.
Well, in this case, from Alex J. Pollock.
Okay.
Give credit where it's due. But I am in fact relating it to yes or yes.
Yeah, exactly.
I'll take partial credit for this.
Awesome.
Because Alex is my friend.
I'm sure he's going to be happy with that. Jim, to talk about another yellow commodity, uranium. You wrote a piece on chemical in 2017 and then again in mid last year. So you know the sector well. Uranium went up by around 40% last year from the lows in mid-April. So do you think 2019 will be the year for uranium investors? Because
I think so, Marcelo. I asked the analyst, our very fine analyst, Fabiano Santin, who, by the way, is a native Brazilian, and who has come to bring us what we've never had before, which is the capacity to translate documents from Portuguese. Well, it might come in handy.
Yeah.
And so I asked Fabiano today whether he was the very fine analyst who did our work in uranium, whether he sees any reason to change his view. No. So we remain bullish on uranium. I can't add much to the story, but we think it is a most underappreciated and most interesting asset class. So we remain bullish and expect that uranium will continue to come into more and more into the energy mainstream from the margins.
Brilliant. In regards to the markets now, what are the risks that people are not paying attention to, in your opinion? You mentioned now the Fed, and that's a big risk that might come to...
Oh, I have a couple of candidates for. So one is the America's federal government deficit, budget deficit, has been among the least remunerative pieces of information you could possibly know. Mm-hmm. If you had a week's early notice of what the deficit would be for the past 20 years, it would have availed you absolutely nothing, because we've been in a great bond bull market, and even the Treasury of the United States is not the defining or the most important institution in the world's vast dollar fixed income marketplace. But what is new this year is that the weight of supply in the market for dollar-denominated government debt, that's new. If projections pan out, the sum total of new borrowing by the United States Treasury on the one hand and dispositions of securities by the Fed, it's attempting to normalize its balance sheet. Those two sources of supply, the Treasury and the Fed, will give us a weight of securities in relation to GDP that is the highest since World War II, since 1945. So there'll be an immense supply burden on a market that may or may not be vulnerable to that. And I say may or may not because if there's a recession, this is not going to count for so much as a bear factor. But let us say that the yield curve gives a false signal, and that the American economy, as it has done so often in the past, surprises to the upside. It might just be that interest rates, too, surprise to the upside. If I sound as if I am hedging my bets, I certainly am, believing as I do that one really can't know these things. One can guess and hypothesize. But that's one risk, I think, is the risk of an unscripted lurch upward in interest rates, propelled in part by the sheer weight of American Treasury borrowing. A second risk has to do with the banking system of Europe. Deutsche Bank is selling at 20% of book value, but most of the other big banks in Europe are similarly stigmatized in the marketplace. And I think there was exactly one bank in the Euro All Stocks Bank Index, or All Bank Stocks Index. The only thing I recall about this index is they spell stocks STOXX, which is a peculiar way of spelling stocks. So that's the way to do it. But European bank stocks have been pummeled as if someone knows something about the state of European credit. And indeed, the ratio of bank assets to GDP in Europe is very high, and the ratio of non-performing assets to all bank assets is itself very high. So there's a saying in markets, of course, that if it's obvious, it's obviously wrong, or at least it's obviously priced in. But with respect to Deutsche Bank and some of the other big and dubious banks in Europe, I wonder if it is priced in. So I would nominate, Marcelo, two very different problematic scenarios. I would nominate American interest rates and European bank credit as potential sources of disruption and news in 2019.
Brilliant. And by the way, is there any question that people rarely ask you that you think is relevant?
Why do I keep doing this at the age of 72? Well, I keep doing it because I want to be around for the denouement. I want to be around for the finale. And then there never is a finale, of course. We go on, and humanity is indestructible, which is a very nice thing. But I do want to be around, writing and observing for the what I hope will finally be the realization on the part of the marketplace, broadly speaking, that the monetary regime in place is a corrupted one, not personally corrupted, but corrupted in its concepts and in its application. And what is wanted finally and wholesomely is price discovery rather than price administration, especially in the world of interest rates. So people don't often ask me that because it seems like a rude question, but I will ask myself that, and I have just answered it.
Awesome. That's all we wanted to know. So, Jim, listen, once again, many thanks for coming to this program and sharing your insights with us. It's always a pleasure to talk to you.
Marcelo, it is a delight, and I can't tell you how grateful I am for your subscribing to grants and your asking such fine questions over a very long telephone line.
Brilliant. Thank you very much, Jim. Talk to you soon.
Bye, Marcelo.
If you like this podcast, feel free to forward it to your friends and colleagues. We appreciate your time, support, and your feedback. You can follow Marcelo López on Twitter at MALopez1975. The information presented here is not investment advice and should not be taken as such. You should do your own due diligence and consult with your financial advisor before doing anything suggested or mentioned in this podcast. L2 Capital and its partners will not be liable for any losses that occur in doing whatever is discussed in this podcast.